somebody is in a $9,000 a month facility. They're typically relying on either I sold my house, so I'm using that money, or I'm relying on stock market returns or something of that nature. Suddenly that disappears, and this person lives longer than, one might expect them to live.
Sure.
You can have a problem with how you're getting that $8 or $9 grand a month. By focusing in this middle market, we aim to have everybody that comes in be able to pay their monthly rent with their recurring retirement income.
This is the real estate investing experience. We get it. Real estate can be rough sometimes, and that's why we bring in the experts to talk about the experiences you won't hear anywhere else with your hosts, John Cohen and Chris Grinzik.
What's going on, guys? Welcome back to another episode of the Real Estate Investing Experience. I'm your host, Chris Grenzig. Across from me, as always, John Cohen. How you doing?
No complaints. Day before Christmas Eve.
Yep.
So sort of just waiting back, see how this year finishes. That's about it.
Yeah. Going to be a little bit busier period than usual with the two deals and some of the hiccups.
Some of the hiccups will probably stay busy, but hopefully we can enjoy some downtime and
for sure
let this year end gracefully.
What plans you got going on?
Got nothing going on. We're probably gonna have Christmas at my house, Christmas Eve at my father-in-law's house.
Nice.
But other than that,
this is the baby's first Christmas, right?
Baby's first Christmas.
Fantastic. I'm sure there'll be a ton of photos we'll be able to get to see.
Yes, a lot of presents already. People are sending us. Not that she has any idea what they are, but
doesn't have enough.
And it's not like the house can, we have toys everywhere. So, but be that as it may.
Yeah, but that's what it's about, spoiling the grandkids, right? And the kids.
Exactly.
Yeah. But awesome. We'll jump right into it. We got a great guest in today. Really interesting. Just met him the other day, but super excited to have him in. Our neighbor in the building next door. Didn't even know it. Another real estate group nearby, but just went over, got to chatting. They're in the assisted living, senior living facility space. So I think it's going to be really interesting to talk about that versus traditional multifamily or other assets. So I'm excited to jump into that, but without further ado, Rich, thanks for joining us.
Absolutely. Thanks for having me.
Awesome. So can you take a minute, 2 minutes, 5 minutes, just tell everybody who you are, your background, how you got into real estate a little bit, and what you guys do now?
Absolutely. So serial entrepreneur and investor, have started and exited multiple businesses over the years.
Okay.
First one was a company that I started in my parents' garage.
Nice.
Designed and manufactured clocks that look like baseballs, footballs, soccer balls. Ended up with distribution in 15 countries and 7 U.S. patents for the products.
Nice.
From there, co-founded the first incubator and co-working space on Long Island. 25 months later, grew that from 1 location to 4, had a successful exit in that business. And from there, I started a venture capital fund, and we're on our 3rd fund now. We invest in early stage technology companies, typically Series C, Series A.
Okay.
And that really was, in a sense, what actually started to lead me down the real estate route. Was startup technology investing tends to be very high risk, not a lot of security in the asset class.
Right.
And a lot of folks that were investors in that were kind of saying, hey, do you guys have anything in the real estate space? So I ended up connecting with my now partner, Anthony, to start Cedar. And we identified that there was really this market in the, let's call it Southeast United States, where migration patterns were moving. And in these smaller boutique size facilities. So, you look in our area here, you'll have these big names that open up these 5-story facilities. I compare them to Times Square hotels.
Sure.
That's not the market we're in. We're in a very specific middle market. So you have your low-end facilities that take Medicaid. You have your high-end facilities that are maybe, $8,000, $9,000, $10,000 a month. We look to be somewhere in the $3,000 to $5,000 a month range per resident. So really right in the middle. So what we did is we said, well, before we go out and raise money from other people, let's put our money where our mouth is.
Absolutely.
So we acquired our first facility a little over 2 years ago, fall of 2017. And when we took that facility over, it was doing about $83,000 a month in rent roll. 12 months later, that facility was doing $83,000 a month in rent roll. We had boosted up to $158,000 a month in rent roll.
That's incredible.
So great growth, managed to do a cash out refi, resulted in 4x cash on cash return in 13 months. So we obviously at that point, I think we would all here agree, we proved out the model.
Sure.
So we proved out the model, and then we set off this year to bring on outside capital and really grow the business. So we're now a 6 facility portfolio with over 200 employees across 3 states. Virginia, South Carolina, and Georgia. And we're doing well right now. Of the portfolio companies or facilities we acquired earlier in the year, we're about 9 months ahead of schedule with our distributions right now, which is great.
Yeah. Can't complain about getting money earlier than you expect, right?
No, makes a lot of people very happy.
Yes, that's for sure. So that first deal, but when you set out for proof of concept, because I think a lot of people do that. I think a lot of people want to say, okay, let me see if I can do it, and then before I scale it. How long did it take you to find that first opportunity? And then when you guys saw it, did you realize it was so almost 50% underperforming more or less, or 100% underperforming, depending on how you look at it? Do you think, was that something that you guys set out for, or did the first one you look at and you said, okay, it took us this long, this is exactly what we want, let's own this, and then we'll go raise money? Or it was just, you just knew that,
So we had started out with a set of criteria. It's 18 items, and we use the same criteria for all of our facilities. So that was kind of our, call it a business plan per se, for lack of a better word. And we said, we're only going to buy facilities if they check every single one of these boxes. If a facility doesn't check one of those boxes, we're not interested. So we knew we don't buy any assets that are losing money. So these are not distress situations. These are truly value add situations, I would call them. So we know going in, we're not going to be, hemorrhaging or burning cash. We know we're going to be able to cover our mortgage. And it's just a matter of taking something that might only be throwing off a very small amount of EBITDA and really bumping up the bottom line by increasing the revenues. So we knew with this facility in particular that there was a huge, huge missed opportunity for increasing the revenues. So we knew that going in. As far as the question about how long it took to really find the place, I would say it took probably a year and a half or so, give or take. And then, so we bought that in 2017. In 2018, we didn't acquire anything. And now 2019, we acquired 5 other assets. So we're not going out there to just buy anything. I mean, similar, like you guys are in the space. I can't even imagine how many brokers lists you're on. You guys probably get the same 100 emails a day. We probably get slightly less because we're in more of a niche market.
Sure.
But nonetheless, there's a lot of junk out there.
Yeah.
And we're very, very focused. We have no problem saying no. We have no problem waiting until the right deal comes along. And it just so happened, the 5 that we closed on, we're within an 84-day time period.
Oh, wow.
So, you wait, and if all the deals are right, then we're going to move on the ones that make the most sense and, generate the most value for our investors at the end of the day.
Yeah, for sure. So before we get too much into, I do want to talk more about, how you see the space and all that stuff. How did you get into the space? Because you obviously came from different backgrounds. It's not like you were in this space, and it's a little bit different than, I'll call it traditional real estate because it's got the healthcare component to it. What was that like, and how did you get into it? How did you get yourself prepared for it and all that fun stuff?
Absolutely. So when Anthony, my partner, had come to me originally, I also have a background in between those other things I mentioned before. I've done some M&A deals of rolling up companies and selling them back off.
Okay.
So I really had a decent amount of M&A experience as well as the capital raising experience through the venture side. He himself came to the table with a background in both AL and more operations based.
What's AL?
Assisted living.
Okay, sorry. Gotcha.
We have assisted living AL. IL is independent living. MC is memory care.
Okay, perfect.
So yeah, he came with more of an operations background, and then we also have somebody else that we've added to our team since, who spends give or take 20 plus years in the senior housing space, both as an owner and an operator. So we really kind of put together the perfect storm of operations, finance, M&A, really all at once.
Gotcha.
And yeah, that's kind of how the crew came together.
Yeah, I think that's hugely important because you went out, knew what your limitations were, and instead of trying to coach yourself up and figure it out, you were the puzzle piece that they didn't have, and they were the puzzle piece that you didn't have, and you guys were able to put 2 or 3 together and make it work.
Exactly. Like. I think one of the smartest things in any business, be it real estate or anything else, is knowing what you're good at, but more importantly, probably knowing what you're not good at.
Right. 100%.
The guy who thinks he knows everything at the table is usually not the smartest one in the room.
That's for sure.
100%. But getting back into, I guess you're talking about deals and what you guys look for, can you talk a little bit more? You said 18, you don't have to go through all 18, but what is it in deals and what is it about the space that you guys are really looking for in these things besides underperforming, because that's
sure. So
everybody wants
one of the big keys I'd say is 100% private pay.
Okay.
So what that basically means is no insurance, no Medicare, no Medicaid.
Okay.
This works like any other landlord-tenant play. Invoices are sent out on give or take the 20th of the previous month, then rent's due the 1st of the following month. And That's it. Plain and simple.
Sure.
There's people that come in that have long-term care insurance. That's fine. They have to go and apply for reimbursement at their long-term care insurance company.
So yeah, they pay first.
Exactly. Okay. They pay first. They can then submit, here's a copy of my check and my invoice, and they can wait to get the money back
from them. But you guys don't deal with that at all.
Not at all. Not at all. And that's where kind of, I'd say the biggest first criteria is. We've looked at facilities where there's just 1 or 2 out of, say, 50 residents that are on Medicaid. And the brokers are always so quick to tell you, oh, don't worry, you don't have to keep those people. You know, you don't have to take over their leases. You're a new owner. We don't deal with any of that nonsense.
Gotcha.
If it doesn't check every box, we're not interested.
And I was going to say, that's got to be probably on the top side of 18.
That is the first. That's
because that probably weeds it out,
Correct.
quickly, where you don't have, you don't have to spend any brain damage whatsoever getting in the rabbit hole.
Exactly, 100%. That's the first thing. The second thing we always ask about after that is, does each room have a private bathroom?
Okay.
So there's some buildings that are older that might just have, toilets and sinks, but they don't have showers. If you're, 90 years old, there's a certain point where everybody wants to feel like they're back in college, but maybe not everybody does. And you don't want to have to walk down the hall in front of 20 people to go take a shower.
Right.
So if they don't all have full private bathrooms in each room, that's, I'd say, kind of the second main criteria. Then after that, there's kind of standard, as you guys probably know, certain building stuff. When was the building built? We're looking for buildings that were typically built in the 90s, but renovated in the early, call it mid-2000s. I mean, it's crazy. I think we're going to another decade.
I said that the other day. It was, because, we've historically bought very, very fucked up 1960s and 70s built stuff. Now, those buildings are not 40 years old anymore. They're 60 years old. So you're like, wait a second, this got real problems.
Exactly. Exactly.
Whenever anybody does, like, you always hear 60s, 70s built. When you do the opposite and say how old it actually is, I'm always like, oh, fuck, we're buying something so old.
Well, because it's funny. When I started as a broker, they define A, B, and C class properties. And they're like, this is 20 years old and 40 years old. I'm like, yeah, not anymore. Then you're a C class, and your older stuff is not. It's 60 years old. It's crazy to think that that's where we're at today. So I can truly understand that. We have that battle all the time in here. I actually emailed Chris this weekend, and I was like, let's take our acquisition criteria and really put it into like a small, like a very, 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 this is what we're going to buy. If it's not that, don't even waste our time, because you're going to waste your time going down the deal rabbit hole. It's never going to happen.
And as you grow, as you guys have, kind of similar to the way we have, I mean, you just get so much more deal flow, and you want to spend your time on quality deals.
Correct.
For sure.
So you want to be able to rule out the junk as quickly as possible.
Yep.
Yeah. Well, I mean, even just, was it now, probably 18 months ago, we went from buying the value deals anywhere on like the east side of the US down to we narrowed it down to 7 or 8 markets, and really only certain types of buildings, and just from there it saved us a ton of time.
Yeah, you could just scratch a deal. So I think it's important, just as important as having that list of the do's and the don'ts. You also have to be aware of, if it's too narrow, you're never going to buy anything. So that was probably a delicate balance that you guys, coming from your backgrounds. And now that list was put together. I don't know if it was 3 of you guys sitting brainstorming, or more on the operation side. Hey, I know we can get good here. But, I have a friend that I speak about all the time. She was actually on our podcast, one of the earlier episodes, that was so focused on a market, but there was never much velocity in that market. And that was her market. And it took her a little bit, harder to get started. But if you guys, I know this is an if question, but if nothing happened as quickly, or as how it did, I shouldn't say as quickly, would you guys have been willing to bend on any of those 18, or those 18?
I don't think so. I mean, and to your point to how we kind of develop them, I'd say we develop them actually by looking at other potentials. I mean, able to go in and spending time and analyzing, well, can we make this one work? Well, we can, but maybe not, maybe property A is not going to be as good as property B that we're looking at. All right, so now let's identify what the differences are and put them on paper.
Yep.
The stuff that's in property A, here are the few things that aren't going to work.
So I'm glad that was the answer, because I think people, it's like the chicken before the egg, right? So it's like, do I know I want to buy 60s built deals, or do I not? You may not have any idea. You may say, I want to get a 15% return, or a 40% return, or a 3% return. So if you work backwards, you got to try each one, and you got to say, hey, it's worked for me or not, and then be smart enough to be aware that it goes on the do list or the don't list. And that's something that you guys did obviously well. and you stuck to it. You didn't bend, which I think is impressive in the market that, this current cycle, whether, and I'm not super familiar with assisted living and any of that, but I'm sure you guys saw a ton of transactions happening, and maybe some days were like, when's ours coming, or when's it going to happen? And that's to stick to a game plan and deliver on it is awesome.
I think one of the things that's also kind of important for us is we're really evolving, a full brand here. So it's a real estate company, but in a sense, it also operates like a private equity fund because we are employing over 200 people. So we have, the security of the real estate asset, but plus the returns that you would typically see in a PE type asset. And with that kind of comes our long-term exit plan. And our goal is to really build this up as a community-oriented brand and sell it off to whether it be a PE fund, whether it be a larger operator, whether it's to spin the real estate off into a senior housing REIT and keep the operating side of it running. And in order to do that, we need to have that consistency.
It's got to be the same.
Exactly.
So break that down, because I'm not sure I follow 100%. When you say like the real estate side and the operating side, is that like the physical real estate and then the 200 people, or is that like the real estate, the 200 people, and then like your corporate office? Like how do you delineate?
So everything? When we do a deal, we acquire the physical real estate, and then we also acquire the actual operating business at each of these facilities. And each facility has, 30 beds, 40 leases with all the residents that are there. I mean, these are 24/7 businesses.
Right.
So there's employees in these buildings 24/7, 365. We're serving 3 meals a day. We have a kitchen staff. We have a recreation staff. We have caretakers. We have a housekeeping staff. We have an administrative staff. And that's all just at the individual facilities, not including, kind of what's in the back office here in New York. So we separate those two off with each acquisition. And I'm sure you guys kind of have separate LLCs for all your deals similarly. So what we do is for each deal, we have one LLC that actually acquires the real estate and another LLC that acquires the operations.
Interesting.
So that way down the line, we have the ability to kind of move around or
some
exit
flexibility,
any line of business that we eventually elect to.
So when you say, and then you were talking about possibly like rolling off the real estate side and keeping the operational side, is that like you would operate those properties you just sold off for the person that bought it?
Correct, and under a lease agreement.
Gotcha. So you'd be almost like a management company per se.
/ tenant at that point, really, of the real estate. So there's a bunch of senior housing REITs out there. And what they basically do is they acquire the portfolio of real estate. They then lease it back to the operator.
Yep.
Gotcha.
And the operator then, typically they're triple net leases, and the operator then pays their rent each month, but they can still take advantage of the economics of running, good assisted living business.
For sure.
Or similarly, you spin off the real estate, and if we elect not to be the operators, you can sell it off. We've all heard of Brookdale and Atria and these big players. So they own some real estate, but a company like Brookdale actually operates more properties than it owns.
Interesting.
So it is in the real estate business and owns properties, but more likely than not, it's operating a facility that it's leasing the property from. So we've kind of set ourselves up with a lot of flexibility, but the key, I think, with that exit flexibility is just keeping consistent with your portfolio. Because if you have stuff that's, this asset was built in 1960, this one's built in 2005, and these have private bathrooms, these don't, it just becomes a nightmare. Who's going to want to acquire that portfolio? Yeah,
it's going to be harder to sell it off. If it's branded and cohesive, it's a lot easier to bring it to a bigger group or someone else.
I mean, the other thing is, since we do focus on these more boutique facilities, we get in at very, very good prices. And people frequently say, well, how do you guys get in, so much lower than what market is? And the main reason is that there's not a huge amount of buyers in this 50 or so unit space, let's call it.
100%.
Because while they're still multi-million-dollar deals, they're too big for, a mom and pop family business to come and acquire, especially in these, southern markets where we are. But they're too small for a large player to want to come into because it doesn't move the needle. But now you roll up 15 or 20, 50-unit facilities. Yeah. Now say you get, 1,000 units. Now it's going to move the needle for somebody.
Yep. Sizable.
And, similar to what, you look at what a Marriott's done with Take Their Fairfield Inn or Courtyard or any of these, smaller brands. And you could really put yourself in that same market for a bigger player. And now they have exposure in these kind of secondary and tertiary markets, which they would have not been able to get otherwise.
Yeah, I think they're also, and correct me if I'm wrong, you're probably a little bit more insulated than like we are from new groups coming in, because the whole operational side is so much more sophisticated, hands-on in the weeds than like if you were to come in and just buy a 50-unit multifamily deal. And that's where it's interesting from your side. Like the operations is such a, I don't know if I want to say tougher, but more work and probably harder to do than, for us, it's, if you've got people, it's, a 50 unit property, you probably don't even have on-site staff. Maybe you have a super, or maybe you have a leasing and a maintenance or something like that, where it's not, 50 people working there or 30 people working there. I don't know what the, person to bed ratio is, but it's got to be significantly harder for, let's say like tomorrow, we're going to go buy assisted living. The barriers to entry are significantly higher than if it's like, I'm going to go buy a, 50 unit multifamily. So I'm sure that protects you from like the new entry as well, where I think if you're going to go out and try to do the same business plan on the multifamily side, I do think there's a ton of opportunity. And we speak about this all the time from direct to owner mom and pops and stuff like that. But it's very easy for a mom and pop to go buy a 50 unit multifamily. They just have to go find a manager and have the money to do it, basically. So
it's actually what you bring up. We talk with our investors, especially the ones that are new to the space, which is the majority of them, pretty frequently, because they'll look and they'll say like, oh, well, you charge people rent on the first of the month. What do you have, one super that works there? And then we say, what one super? That's the morning shift. Then you have the overnight guy and the other 28 people that are working with them.
Right.
So these are big ongoing concern operating businesses, which is a great point that you make. And you're absolutely right in kind of the barriers to entry. These are all regulated, licensed healthcare facilities. You can't just go and say, hey, I want to be in the assisted living business and, buy a multifamily and turn it into an assisted living, or, go and buy, an old hotel and turn it into assisted living. You have to go through the state regulatory process. You have to get licensed as an operator. The building has to meet all the criteria to be a healthcare facility. And there's obviously ongoing compliance that comes along with that. The second thing that we do, just from a barrier to entry standpoint, if you don't mind if I kind of go down this road a bit,
for it.
Is focus on these, as I mentioned, secondary and tertiary markets. So like any other market, you can only fit, so many people, supply, demand, that sort of thing. And we specifically don't look to be in, take Atlanta, Georgia.
Sure.
Everybody's heard of this table of Atlanta, Georgia. My guess is you probably have not heard of Commerce, Georgia. It's about an hour and change outside of Atlanta. Beautiful, beautiful town. Perfect market. And we have 2 facilities there, the only 2 in the area. And no big operator is interested in coming and building a 200-bed facility in Commerce, Georgia, because there's no market to support it.
Right.
So we have the ability to kind of control that market. We are not interested in going into Atlanta, where that primary market area has anywhere at this point, depending on whether you count independent living and assisted, but somewhere between 17 and 22 facilities that are all north of 100 beds apiece.
Right.
Because a new guy could come in and build a giant new building, or suddenly the market's not as good and money is tighter and you're in a lot more competition. And that's the other important part about, we kind of focus on that mid-market that we talked about earlier. And what's really interesting about that market is we're really insulated from economic downturns. So if somebody is in a $9,000 a month facility, they're typically relying on either, I sold my house, so I'm using that money, or I'm relying on stock market returns or something of that nature. Suddenly that disappears, and this person lives longer than, one might expect them to live.
Sure.
You can have a problem with how you're getting that $8 or $9 grand a month. By focusing in this middle market, we aim to have everybody that comes in be able to pay their monthly rent with their recurring retirement income. Social Security, VA benefits, pensions, annuities, things like that. Our goal is that our residents that come in don't have to touch their savings at all. And that also makes their kids, who are the ones usually doing the shopping,
feel really good about it, because they know they're going to get money when mom and dad die.
Exactly. The kids don't want to hear, oh, well, and these are, of course, different than we're all here in New York. So economics are obviously different.
Yeah.
But, down there, somebody sells their house might sell for $200,000. 200 grand to 10 grand a month goes really, really quickly.
Yeah,
so if you're here, hey, your nest egg is going to be safe, and we're just going to draw down from this recurring money every month, and it's not really going to cost anything, because this money will be going to pay their current mortgage or their living expenses or anything else anyway. It makes it kind of a much easier sell. So we look to specifically be in that market, which is where some of the, flashier guys, let's call them, are not looking to be. And we had actually explored, kind of going back to how we looked at our criteria, we had explored going into an Atlanta primary market area facility at one point, and we saw no value, honestly. It met to the point about, hey, it met the majority. I'm not going to say how many of the 18, but it was pretty close. But the one that it didn't meet was that it was in a major metro. And we explored it just to kind of test the waters. And the returns, no way in our opinion, outweigh the risks. You know, we are better off being in a small market where we can get, you know, grassroots marketing in place with the small towns. I mean, the owners that we take over from, and we're all probably going to laugh at this too, and we're doing a podcast here. These people are advertising the Yellow Pages.
Right.
You know, this is serious. I mean, that's what their market is. I mean, we go in, we do Facebook marketing, we do Google AdWords, and you're usually not paying a ton per click for this marketing in these smaller towns, because if you're the only deal in town looking for an assisted living.
Exactly.
I mean, we're usually drawing for between 25 and 45 mile radius for these facilities. I mean, when you think about here, 25 to 45 miles here, it's like a totally different ballgame. But in these smaller communities, that's how we kind of also prevent the barriers to entry. We just know that we're in such a insulated local market,
and the migration's got to be even larger. I mean, in our business, if people aren't going there, they're not going to live there. But if people are getting older, they're getting older and moving to areas that are cheaper. That model just, you know, even more so, you know, they're moving into these areas. It just helps you guys that much more. I'm
exactly.
assuming.
And what's nice about being outside the main areas is they might have kids or grandkids that, you know, live in Atlanta, but knowing that, hey, they can still come visit me an hour away. It's not really that big of a deal. And someone at that age doesn't want to be involved, in our opinion, with all the big city hubbub. You know, who wants to deal with all that? You know, get a big piece of land, all, you know, that whole sort of thing.
Now, I have a question about that original deal that you guys, your proof of concept, because the income went from X to Y and it was a huge jump. Is that you just raised the rent? Or is that just we added a recreation team, we added so many more options for them? That was something that
our goal is to go in there and not, you know, seem like the big bad wolf from New York that raises everybody's rent $1 gazillion. So we look to get into markets where the rents in the facility are usually somewhat stabilized, but there's two main things that we do. Number one is assisted living facilities have two licensed amounts. You have your unit count, which is how many rooms are in a facility, and you have your bed count, which is how many beds you can fit in that many units. So you might have a facility that's 30 units, but 50 beds. You call up the owner that's not watching their business. They say, hey, I have 30 units. There's one person in each room. I'm at 100% occupancy. My business is doing great. We sit there and say there's 20 beds worth of people that you're leaving on the table. And that's where there's a big opportunity. The other thing is fixed rates. So what you'll see, and this tends to be something we see in all the small towns, nobody likes to follow a rate card. So
what is that?
So you guys probably know in your business, a 2-bedroom apartment is whatever, $1,800 a month. I'm just making up a number.
Nope.
Much higher, but
$2,500 a month, $3,500, whatever.
No, I'm saying you were very high for what we buy.
Okay.
Yeah. We're in like the 1,000 to 1,300 space.
So whatever that is. So if somebody came into you and said, all right, so this 2 bedrooms regularly $1,000 a month, I'd like to pay $400. Are you saying great? Come on in. Probably
bring
not.
all your friends.
Yes.
Probably not, right? So what tends to happen in these small towns is, you know, somebody's friends with the old owner or the old administrator, and they get a deal. And now the next person comes in, and I'll just use that same, that same example we're going off and say, oh, I heard, Ethel's paying $400 a month. Why am I getting quoted $1,200 a month?
Yep.
I want to pay $400 a month. And now before you know it, you start to artificially lower your price point.
Yep.
So we have typically 4 fixed rates in each facility. Private assisted living, shared assisted living, private memory care, shared memory care. We negotiate 0 of those rates. That's it, plain and simple. With that in mind, when we come into a facility, we honor all the rates somebody had.
Yep.
And then over time, we'll slowly start to kind of inch them up as we make improvements to the building, as we make improvements to activities, and people see that there's value in new ownership, that it's worth paying a little bit more for. And we're also in a business where there's, I don't want to say a high level of attrition, but the average length of stay, as we refer to it, is about 28 months. And most people that depart are not departing to go somewhere else. They're departing because they have departed.
They're not leaving because another place is better.
Exactly.
It might be better, but it's just that other place is not another assisted living.
So with that in mind, we also know, if you have somebody, in an apartment building that moves in, they're 30 years old and they're paying $400 a month, that person's probably not moving out too quickly.
Right.
But in our business, we know that we can wait a little bit, and we're just going to have, over the course of that first year in business, give or take, half of those people are probably going to move on. So we know we're going to be able to replace 50% of those rooms
Interesting.
at our newer, higher rate without having to really go in and change a tremendous amount with the rate structure.
Mm-hmm. So how much do you guys worry about? Because we talk about supply and demand all the time, and you obviously spoke about that as well, but we went opposite to you and we said, hey, we'll actually take, lower returns than what you would expect to see in, secondary, tertiary markets for the larger areas with like 1 million people or more. Because we think, one, management on our side, we're not in-house, so we have to have better management resources, which is harder to find in these other areas. But also, we just think there's better insulation from downturn in larger areas. How do you guys, view, small town? You're such a large percentage of the demand. How ingrained do you get in that area, looking at like the sustainability, the economics of it, making sure that like, hey, this, I don't know how big Commerce, Georgia is, but it's probably 100,000.
Not that big. That's why we look to draw from the 25 to 45 mile
but
radius.
Even that radius, whatever it is, you're talking a couple 100,000 people or less. If you're such a large portion of it, or such a large portion of that market, how, that takes on some amount of risk, right? The larger piece of the pie you are, the more at risk you are for that pie diminishing if you're a larger piece. How do you guys view that? How do you mitigate it? How in depth do you get into like that local area, the economy, the the politics and stuff like that?
We do tons of boots on the ground due diligence. There's not a lot of publicly available reports on most of these communities. Even if you have the paid search systems and this and that, the data coming out of Commerce, Georgia is, not much to rely on. So what we do is we literally go down there and we spend a ton of time in those towns. We spend time in the neighboring towns. We spend time in the towns where the employees come from, because we have to know how hiring is going to be and what type of employees we're dealing with at these facilities. We're going to the local fire stations and pretending as though, grandma needs a place to stay and I'm from New York and I don't really know the area that well. So, hit me in. What type of, what assisted living? If your mom needed somewhere, where would you send her?
Right.
As hokey as it sounds, the local Waffle House tends to be a great place to get information, which all these towns usually have one.
Right.
And you go to the local Waffle House and sit down and talk to your server while you're waiting for your pancakes and coffee and, tell me about this. Oh, I have a friend that works there. Oh, does your friend like working there?
Yep.
Oh, one of the chefs actually does, the night shift as a cook there. Oh, bring him over. I'd love to hear about it. And that's honestly how we do a lot of our diligence.
Interesting.
And there's many places where, we'll stop by the local firehouse. Oh, we're at that place every day. There's constantly somebody falling or this or that. And we say, oh, that's wonderful. Thanks for filling us in. I mean, maybe not so wonderful, but you catch the drift, and we know that's not a deal for us.
So you don't like that?
If the fire department's there every day and there's people falling, it means the care's probably not good, and it means there's probably
the help might not be good.
Right. So you don't see that as an opportunity then? Because I heard that and I was like, oh, that sounds like great news.
So that's
for us, we're always looking for disasters. So
yeah, exactly. Yeah. And that's kind of where I mentioned before, we're very cautious that we don't really describe anything we do as distressed.
Right.
We describe it all as value add.
Sure.
So we want to know we're coming into a good, solid business.
Yeah.
And to the point about, the regulations, you don't want to be in a spot where you take over a facility and suddenly people hear there's new owners in town. So now I'm going to go to report everything that's happened.
Yeah, because then
now you have license issues and everything else.
For sure. Yeah, that's true.
So yeah, we like to know that we rely heavily on our administrators. So by law, each facility has to have a licensed administrator in it. So we're relying on knowing that, hey, there's a good licensed administrator. And I point that out because we're not relying on old owners. So if there's a business where call it husband and wife were the administrators, that's not something that we're really interested in.
Gotcha.
Yeah.
Because now they leave. It's like I always relate it, when I did other M&A deals, I did a lot of stuff in the construction industry. And if, Bill's Electric Company was up for sale, you really didn't want to buy Bill's Electric Company, because if Bill wasn't there,
right,
it didn't work.
People were using it because it was Bill's Electric Company. If Bill wasn't there, they weren't interested in using it.
Yeah.
So it has to be, which is, it's interesting because they've mentioned small towns so many times, but it almost is the administrator usually being ingrained in the small town.
Well, yeah, it's interesting you say that, because I was listening to some sort of podcast or book or something. They were talking about like systems basically. And they said like he was talking to somebody and said, your business is worthless because if you leave, you have no systems in place. So your business may bring in, I forget what it was, but let's say it was $1 million in revenue and, you net $300,000 a year, whatever it is, it doesn't matter because without you, that business brings in nothing. And I thought that is super relevant to what you were just saying, where you're looking for, you guys are, real estate, we buy, they're basically mini businesses, but yours is even more so like a true business that you're buying, at least on the operational side. And you basically want the administrator, or when I heard you talk about it, almost like the CEO of that area, where you guys are almost like a board coming in, it kind of sounds like, and correct me if I'm wrong, but you're looking for one that has the good systems in place, but they're just not maximizing everything in their, business or care or whatever.
Correct. I mean, one of the things that we have the ability to do is through our office here, we centralize a lot of those procedures, ordering, spending. So absent the revenue increase side, which is obviously incredibly important, managing the expense side. Because most small businesses don't spend a lot of time managing their expenses. And while percentage-wise it might be the same, hey, they say, well, it's 10%. What's saving 10% on food, for example? But, on the whole, we order close to $750,000 of food a year.
Right.
If we can shave off 10%, 75 grand, it's real money.
Yeah.
So whereas,
goes a long way.
as a one-person shop, they look at it and say, oh, well, if we're ordering 100 grand a year of food, 10% is 10,000, $800 a month, we're not going to spend a lot of time worrying about that. But we bring all that stuff in-house, supply ordering in-house. And as you start to manage that more, not only do you cut down on costs and get, better economies of scale with bulk ordering, we also cut down stuff that walks out the door that old owners don't necessarily pay attention to.
They're not paying attention to it. Because like when I'm here and I'm listening to this and, it's like, people have probably made this analogy before, but it's like mobile home meets self-storage meets multifamily, where they sort of all, like we're buying a mobile home park right now and we can't find someone to test the water. So the old owner's like, well, I'll do it for $100 an hour. And I'm like, that's crazy. And these people that it's part-time work, it's once a day, going over there, making sure it's all right. These people want $40,000, $50,000 a year to do that. These like water testers. I'm like, but it's crazy because, like you said, an old owner that's owned it for 20 years, 40 years, whatever it is. And, I let her take a couple things because she's a really good employee every month. And, you take that and you make that professionally run. And, $800 times however many, places you can save, that does add up significantly. And that's,
it's any inefficiency play you look at is not anything drastic, but it's little changes here and there. And then when you add the revenue increase on top of it, that's a big pop, especially when you're talking about I think you were saying when we met the other day, you guys look to improve, refinance and hold for like 5 to 7 years or whatever Correct. It may be. That refinance is, every dollar helps because it's a, whatever multiple and whatever cap rate you guys are operating at gets multiplied significantly. So it's way more than just the $800 a month. It's how much in debt are you going to get increased and how much more equity you're going to pull out and how much does that improve your cash flow going forward.
The value that we add to the overall project and the investors and everything else by doing that, like you said, it's, you're talking tenfold type multiples on that money, and you do that per facility. It's real money.
Right. Well, that's when we talk about like improvements to units, when unit vacates and we do interior upgrades, we always look at like your ROI on money spent versus increased rent, which is, like $100, $1,200 over 5,000, you're 20-ish% or whatever it is, or 25%. But there's also the, the concept of like, okay, what is that also ROI on, value as well? And sometimes we get into disagreements with managers or other operators, like, what is more important? Is it better to, get a poorer ROI to improve it more to get a higher value than it is to spend less, get a better ROI on cash flow, but your value goes up less? So like we go back and forth all the time analyzing like, okay, do we do like, a $3,000 upgrade or a $5,000 or a $7,000 or a $10,000, and we'll look at, the difference between, cash flow and value and all that stuff. And, a mom and pop probably isn't looking at it, okay, if I save $800 a month to my bottom line, that's going to increase my value, 10%, and it's going to allow me to refinance and pull out, 10% more than I thought I would have. So I think you probably have a different perspective than a lot of, mom and pop owners or, other people like that, which allows you to find those inefficiencies, create tremendous value for, you and your investors, and, implement the plan you're looking to.
Absolutely. I mean, one of the things we actually did this morning before I came over here was we do a weekly CapEx meeting. We review every single facility and we go through and see what the requests the facilities are and what items we kind of have on our list. Mm-hmm. And we look at that every single week, and there's weeks where we pull the trigger on things. There's weeks where we don't do anything. And we're constantly kind of reanalyzing based on where our spends are, where our revenue is, what's the most bang for our buck, what can wait because we know, hey, a refi is not coming for this amount of time. So let's focus on something maybe first that's going to generate more revenue. And then in 6 months before a refi, we're going to go and pull the trigger on something that's maybe more of a building type upgrade.
So do you guys ever... will you guys refinance and pull out money to spend extra money, or no? We
distribute everything that comes out from the refi. We're not looking to do any major renovations. That's actually, it kind of brings me to a good point. We don't look to do any major renovations at all.
Gotcha. So you don't want
the board. We're looking to really basically what we tell our investors is first year cash flow, we reinvest into improving the building.
Okay.
And when I say building, it could be operational, it could be marketing, but year one cash flow is going to improvements. But we're not in the construction business. We're not looking to do major overhauls or renovations. It's one of the reasons I had mentioned earlier. We really look to have a building that's been renovated, within the last X number of years.
Gotcha.
Because we don't want a huge project. And the refi money is 100% returns.
Mm-hmm. And investors. I'm also sure that business model bodes well for a 5 to 7 year exit. Because if it was renovated 15 years ago or 10 years ago in that 2000, another 7 years, someone could look at that and say, oh, I could raise rents if I, improve the hallways. Or so I'm sure that adds to your business plan, which most people probably don't even look at it that way. Because, we look at deals, and the first thing I tell people all the time is I don't want anyone to have touched the deal for 10 years. Because I know I can go in there and change the carpet out and I'm going to get a rent bump because nothing's been done. You're taking that coin of I want to be... I want to sell it in 7 years to the group that's going to come in and put some money into it because that's when it's going to need another facelift. And you guys don't want to do it, which I think is good to know. You're not getting into a deal saying, we're going to spend, $10,000 a unit renovating things because that's not the model. So I think that's awesome to understand that going into the deal, and then vice versa. That's probably part of that exit plan on that, it helps the exit.
Yeah. So if you guys have a deal that comes along and it needs new roofs or something, is that something you guys won't even touch? You don't even account for it?
We won't touch it.
Interesting.
Because that's
especially new commercial roofs. you guys know, you could be talking 6 figures easily on a big building. So if it needs new roofs, we won't touch it. There was one asset that we acquired and it did not need new roofs. The roofs were redone, I want to say 12 years ago. Mm-hmm. So, we'll be able to exit without doing new roofs, but there were some roofing issues that we identified. We had the seller take care of everything before we closed.
Interesting.
We wanted no issues that couldn't be expensive to us or expensive to our investors. And the other thing, just to kind of talk about your 5 to 7 years, which are spot on, kind of about why we look for that renovation time period, because we know we're not going to have to pour a fortune into any of these buildings. Mm-hmm. And what we're also giving folks the ability to do, meaning whoever ends up acquiring us, is still be along for the upside of the baby boomer population aging. So, boomers are expected to hit their peak, and I think it's the early 2030s, depending on what report you read. But we exit 2025, 2026, or that range. Mm-hmm. You don't want to sell when you're at the peak, because the only way anybody who's acquiring you is to be able to go is down. So you want to sell when there's still a big enough uptrend that somebody's be able to get nice returns on their money for, hopefully taking us out in a few years.
And you guys know that going in, knowing that you're going to take advantage of the operational side while making money, and you're going to leave some meat on the bone for the next guy. You don't want to, milk it, because if you're the last guy standing, then you're
the one that's holding the bag, right?
Exactly.
Well, that's, the deals that we sell when we go in and we renovate. We're not going in and, except 2 deals we're doing now, but we typically don't renovate every unit, because then it's like, okay, what do you do from there? And you don't want to artificially create a value add scenario for somebody else where somebody may or may not buy into it, and then affects your sale and your cap rate. So a lot of our deals, we look at, it's like, okay, we can renovate a third or a half or 2/3, and there's still something there for somebody else where they don't feel like, oh, I'm just buying this and I'm going to have to try to squeeze the last ounce of juice.
Yeah, nobody wants to buy an asset that thing is maxed out already.
Correct.
Yeah, and especially in our space, right? If you're in the, A space or, luxury, then a little bit different. You're buying for long term and there is no value. But for us, people aren't typically buying 60s and 70s built stuff with no sort of value added to it. So, it's the same way that I guess you guys are kind of looking at that we are. It's just, how do we do it? We're doing it, I think, a little bit differently in terms of, how do we leave that value there? So you're saying the uptrend is still there in the macro, where we're more in the micro of like, hey, you can still do this to the property. So I think that's interesting. Talk to me a little bit more about like the actual like space and asset class. Like what are, kind of return expectations if you can go there? What are, cap rates like? What is the debt world like? Because we spoke about that a little bit for people that are like, oh, like just want to learn more about it.
Sure. So a lot of these places, I mean, you can obviously use a cap rate, but they actually tend to be priced on a price per unit basis.
Interesting.
In assisted living. So national average right now hovers around the 220 grand range, plus or minus per unit. And we always look to be at about half of that or less when we're acquiring. So there's big upside. Now, the next question most people ask is, well, it's a national average. How does that fit into these kind of smaller markets?
For sure.
And what we actually found, so the first deal that we did, when it was reappraised for our cash out refi, it actually reappraised at above the 220 per unit.
Interesting.
And just because of the NOIs, cash flows, buildings, where we look to be.
So quick question,
Sure.
because you said you have units and beds, which may always not be equal. That's very similar to like student housing, where a lot of times they price things on a per bed instead of a per unit.
The software that we use that you and I were talking about the other day is actually, it's a student housing.
Gotcha.
It's a student housing property management software since we rent out by the bed.
So does the industry still look on a per unit more so than a per bed?
Correct.
That's interesting.
It's always good from a marketing standpoint. More beds is always better because you can generate more revenue. But yeah, on the whole, the benchmark, and I honestly couldn't tell you why, but the benchmark tends to go more on the per unit side.
Okay.
Than the per bed side.
Is that because there's just a greater trend of like one room, one person in like the macro, or just for whatever reason people just aren't doing it by the per bed? Because student housing, by the macro, a lot of shared rooms, so it's a lot more on, okay, there's going to be more beds than units. It's very rare you find student housing that's like a 1-to-1 ratio. Is it like assisted living? It's way more like closer to that 1-to-1, so it's not as big of a difference.
I don't know for sure. I can say that, one thought I've always had about it is the way these licenses work. So, the first facility we took over when we came in, it was 31 units, 44 beds.
Okay.
Then we increased it to 52 beds. Then we increased it to 62 beds. So I think that there's a lot of, and obviously the state charges fees. They have to inspect, you have to make sure the rooms meet all the requirements to be a shared assisted living room. But absent that, I think that there's almost too much kind of question maybe as to, well, this 31 units is 31 units. There's no debating how many rooms are in the building.
Right.
But one could argue, well, is it 44 beds? Well, I think it could be 52 beds. And I think it would be So I kind of think that that's why they've kept to this very strict, like in student housing. Way more gray, basically. And I don't know it anywhere near as well as you guys know it, but I mean, from the conversations I've had with folks, I know it tends to be, almost all double rooms for the most part. So like, there's a much more kind of fixed number, I think, of a bed count. Whereas in our business, the bed count could fluctuate, I think. And that's the only rationale I can come up with.
Gotcha.
I don't know if that's true or not, but that's kind of...
I was going to say, from an outside knowing nothing, that they know there's 31 doors there, or rooms, so they can quote it like,
right.
Some guys, like you said, you took it from 44 to 52 to 60, or, just you alone increased it by 2. So, that someone else might have said, oh, well, I can definitely get 70 beds in there. And then someone else might have said, there's no way you can go over 44. So I think conceptually it makes a ton of sense, but
it sounds more like, because when the student housing, it's like, okay, you're per the zoning, you can only have so many people, so many beds. So it's a little, more fixed by the area. It almost sounds like it's a little bit more gray and like up to, the licensing and the healthcare and the board of like, okay, these guys have done the right thing so they can put in more. Whereas like the same facility dropped somewhere else, if someone doesn't do the right work to it, they can't put in more beds, right?
Correct.
So
yeah, I mean, if
they
come and do their state inspection, your facility is, run terribly and you can't handle 40 people. They're not going to say, oh, great, here's a license for 60.
Oh, yeah,
so it's
double it up.
So, okay, so that's interesting. So the license on how many people you can have is more heavily focused on the operating capacity than more so the space and what you could potentially have. Is that correct?
I think it's both.
Correct. Yeah,
I mean, yes, you're limited by space.
Like you have to be in good standing with all of your healthcare inspections before you can apply even to increase your bed license.
Right.
So if you're in a spot where, when the state comes, give or take about once a year to each facility. So if they come and, like I said, your place isn't well run, I don't know. We've been thankful enough that we've never been in this position, but I'd have to imagine if the state came and the facility was run terribly, and then you said, "Oh well, we can't operate with 30 people, but we want to put 60 in." The state's gonna say, "No.
Yeah, for sure.
Get your act together first." So that's where us being really smart operators comes into play. Whereas somebody that isn't capable of ramping up and isn't aware of the hiring needs, and you made an interesting point earlier. We mentioned residents to staff ratio,
right?
So knowing that, hey, I'm adding more residents, I need to hire more people. I can't expect the same 5 caretakers to take care of 40 people if they were taking care of 20. Maybe I need a second chef. I need somebody else doing housekeeping. So all these different things that kind of come into growth. Where different than the standard, again, landlord tenant or student housing, where somebody might say, all right, well, we have a bunch of singles, let's change these rooms to doubles. It doesn't really cost anything more. There's really no change to the operation as long as the occupancy can allow for it. There's probably not much to worry about. In our business, you really have to
take care of
plan. Yeah, I mean, these are people that we're taking care of. It's a serious business. I mean, the care, while the money obviously is important, first and foremost is always the care of the residents. Because if you're not taking care of the residents, you're not going to have any residents. You're not going to be in business to make any money.
True. No, I think it's all very interesting talk, because you brought it up and I didn't know this. Talk a little bit about like the debt world, because you were telling me there is no agency loans in this space basically, or very little if any.
Sure, yeah. There's certainly there are agency loans. We haven't went that route because they are definitely harder.
Okay.
So we went the CMBS route on our cash out refis. We're talking about maybe doing agency going forward. It's tough though, because since there are all regulated healthcare facilities, getting approvals and everything, it's a higher risk asset class from a lender standpoint.
Yeah.
So again, all of our assets are doing well. We're well above our debt service coverage ratios and everything else. But if you're a lender, just from the risk standpoint, if somebody doesn't make their mortgage payment on a multifamily, take the property back, send out invoices, the property can really continue operating. In our world, a lender can't just come in and do that.
They can take the property, but the people might not be there anymore.
Yeah, I mean, they're not allowed to operate it without a healthcare license.
Yes,
that's the big thing. That's where he said it the other day, and I was like, oh wow, that makes a ton of sense. Like,
I mean, it actually, so there was a property that we were looking at acquiring, and ended up not for a variety of reasons. And lo and behold, we ended up not, since it was pseudo distressed, and after we ended up walking away, it became a true distressed deal. And to your point, I mean, the bank ended up taking the building, and it went to auction as a vacant building.
Yeah, because if you don't have your license, they're all going to leave. They have to go somewhere else.
The bank had to actually forget they'll voluntarily. The bank had to give everybody notice before they foreclosed.
Yeah, and then they're out.
And it's like, you sit there, and look, I'm not sitting in the bank's shoes, but I mean, at least you were getting, half of your mortgage payment before. At least they were getting set. And yeah, the place ended up going. The bank took it, and obviously, at a foreclosure, it wasn't really worth anything. So the bank's now the owner of this empty building, because who else is going to come and buy it empty and then have to first go and get their licenses and everything else?
Well, is that basically then what happened with Kimberly?
I'm not sure.
That's probably what happened.
No, she was stealing things.
Right, but the city came in and told her like she couldn't operate. So we bought 130 units vacant in Columbus. It's a big project. It was senior living, right?
It was, yeah. So it was multi-built, then it was senior.
Yeah. So
and then it went vacant.
Yeah, so they must have but did the city take it back, or did the
No, it was going back to the bank.
It was going back to the bank, and basically the city.
The city might get rid of, or the state could get rid of the license, but they can't take the building because the bank has the lien on it.
Yeah.
So yeah, they probably
maybe not 100%,
out of business,
but
and
similar.
then went to the bank after that.
Yeah, it was, and she was also stealing HVACs out of the property, her own it was just
people are crazy, right?
This lady was good. Then she was trying to get a commission on the sale for selling it through her brother who worked at the bank.
Okay.
So the day of closing, they looked at it, and the bank's like, "What the fuck is this?" And they're like, "Take that off the stage." It was like $50,000.
I didn't know about that.
Yeah, they were looking at the closing. They're like $50,000. Get the. Are you crazy?
Shake her hand and count your fingers after.
She tried to get paid.
That's funny.
After it was
you can't blame her. I mean,
why not?
Put
Give
it on.
A shot. See if they catch it.
Yeah, I don't know if you're ever doing business with that bank again. But no, but that's really interesting. So Just we'll start wrapping up here over the next, several minutes. What's your guys's, like outlook on the space? What are you guys looking to, how are you guys looking to expand and build? What's the plan for the next couple years? Because you're saying, you have 6 assets now, right?
Correct.
5-7 years. And if you guys look to add more, like what's the goal? What's the end goal?
So,
what's the plan?
Our goal next year in 2020 is to double in size.
Okay.
So we want to acquire at least 6 other assets and be at over 400 employees by the end of next year. That's kind of our one primary goal.
What about unit count?
So as far as unit count, we'd like to, depending on what we look at market, but we're looking to be north of 600 units.
Okay. Awesome.
By the end of next year.
Still, folks, same area. Don't want to.
So yeah, Virginia down to Georgia. We always say anywhere but Florida. Florida is just, in our opinion, completely overpopulated with facilities right now. And it's really become, it's an interesting spot. It's become a place for senior citizens, but not necessarily the baby boomers. A lot of baby boomers are moving to these southern markets.
To the Carolinas. They're avoiding. Florida's getting populated with different people. It's getting populated, a lot of immigration from other areas, from natural disasters, so on. But demographics wise, your Charlestons, your Myrtle Beaches, your South Carolinas, your North Carolinas, your upstate Carolinas, where the cost of living is actually less, and you can still go where you want to go.
100%. So yeah, we're looking Virginia, North Carolina, South Carolina, Georgia, and we're hoping to expand to Tennessee.
I was going to say Tennessee and Kentucky probably have some interesting components to it as well, because those are also great. Tennessee, no income tax, so you have that.
We've identified Tennessee as a great market.
Barriers to entry.
It's really just we haven't found the right deals yet. We've gotten listings. We haven't seen everything that really checks all those boxes, but that's somewhere that's really on our radar for next year. And beyond that, we just want to keep growing the portfolio. We're looking at raising more institutional type funds next year. We've had some interest from institutional investors. So putting that together, more of a committed capital fund. We do deal by deal now, which I think is similar kind of the way you guys operate, which works out really good. We have a lot of really happy investors, but we're definitely looking at kind of starting to go the committed capital route a bit next year.
Would you guys ever consider using your 6 deals? Like, I don't know if there's different investors in every one of them, but like as like an initial seed for a fund?
That's what the institutional guys have asked about. The world. So it's exactly, obviously, we have to be 100% fair to all of our existing investors.
And if they're so we had we have a deal,
and our investors are all different.
It's separate. So we said, let's just start asking, would you mind if? And almost to a T, they all said, yeah, we would mind. But I was like, yeah, but if you could take your investment and be 1% of 10 deals as opposed to 5% of 3, doesn't that make? But we got a lot of pushback for it. But I understand why people want it. And I understand both sides of the coin, but as an investor, I'd love to take advantage of the big nut, not just
It's all about diversification. Our investors are all in multiple deals of ours, but nonetheless, people put different amounts of money in.
Yeah.
Right.
So you end up kind of with that balancing act. But what I always tell people, when they come to us, if they say, I want to put, X dollars into this asset class, I always say, don't put all your money into, this current offering. It looks great. Numbers are good. I think you asked a question before. I don't know if I ever got to it, but kind of where we target IRR wise, we always look to be north of 20% annual IRR on each deal. And there's some deals, we did one in Georgia that's projected, and this is the one that's 9 months ahead of schedule, it's projected to be over 30%. And right now we're delivering. So people see some, it's like, I want to put everything into that, and knock on wood, everything goes great. And right now it is going great.
For sure.
But I always say it's like any other asset class, you want to have diversification. So to that point, having a smaller piece of a giant pie seems like a good move, but it's you got to have a balancing act. I have a lot of respect for our early investors. The people that kind of take those early risks with you when you're starting out are super valuable. And many of them invest with many years in other projects, mainly in the venture space. So with that in mind, if we handle that, we're going to do it, the right way by everyone. But I'll say the people I've spoken to, we haven't had a lot of pushback. It's really just about, where do the economics lie? And one of the things that we're talking about doing is if the institutional wants to come in, at least doing some sort of partial cash on cash takeout versus just a true rollover M&A type deal. And if you do that, obviously then everybody's very happy. Put cash in everybody's pocket. Everybody's happy, right?
Yeah,
nobody ever argues about putting cash in their pocket.
No, people like money. That's sort of like when you get when I got the pushback, the first thing I thought of was, well, what can I give you to make you say yes, right? Because then it's whether we personally take them out or something. But you're right. If someone someone writes you a check,
yeah, so you have a lot less plus a small piece going forward that could be the kicker, and you've only been in these deals for a year.
What's better?
At that point, it's like a home run. And if they want, come and invest. We're raising money. So waive the minimum for those people and say, hey, look, even though the institutional minimum might be $1 million investor, come with whatever you want. You've supported us.
Exactly.
No,
I like that.
Yeah, I think it's all super interesting. I think that's a fantastic place to wrap it up. Rich, thanks so much for coming on. I think this was great. If people want to find out a little bit more about you, get in touch, pick your brain, where can they do that? Cedar, CEDARLP.com is our website. That's probably, I'd say, the best place. And thank you guys for having me. This was great.
Yeah, awesome. No, it was awesome.
Happy holidays, Happy New Year to everybody.
There you go.
Thank you.
Take care.